Welcome to the Global Tech Leaders Podcast, where we help business leaders and individual contributors with actionable insights to hit their number and figure out the nuances of truly operating a business globally today, squeezing the essence of the lessons learned from the planet's top tech leaders. This is your guide to joining the fast track to global market scaling.
Today's show, we welcome Joe Cecala. Now, to say Joe's done it all is a bit of an understatement. He's the co-author of securities research published by Oxford University Handbook on IPOs, main contributor to the Main Street Growth Act, to create venture stock exchanges. Joe is the founder and CEO of Dream Exchange, which creates a new national stock exchange, as well as the first ever venture stock exchange in the US. He's a former military officer, civil rights lawyer, securities lawyer, and CPA. He's a visionary, passionate about affecting positive and lasting change in society. Dream Exchange's newest venture is now over 3,800 social media followers and 25,000 email subscribers, and features media publications as Complex, Wall Street Journal, Black Enterprise, and The Root, and more. He's been on over 100 of these appearances, so he's no stranger. Welcome to today's show, Joe.
Thank you for having me. I sound a bit more impressive than I feel, but thank you for the generous introduction.
Humble needs to be on your bio there, Joe. Well, I don't know how you do it all, quite frankly, but let's try and dig down to get to some of that detail, if we may. So as we often open the show, we ask guests, tell us about your journey. You know, what brought you to where you are, your education, your formative years, and what made you make these decisions, some of these inflection points you had on the way, if you could share with our audience.
Sure. So my journey, I sometimes joke about my journey. I say I Forrest Gumped my way through life. Because it's a wonderful thing right now for me, because where I started my journey in these varying places have now converged into a real purpose for what I'm doing. So I started really as an accountant by trade in the United States, and a military officer first, accountant afterwards. And I started working in Fortune 100 companies doing securities reporting. I was helping draft the compliance reports to the Securities Exchange Commission.
Sure.
I was a bit more passionate than that, and I went to law school at night while working, and really I tried to utilize my experience in the law by studying securities law. But after I began practicing, I realized that the capital markets and venture capital environment, the private equity environment, there were certain aspects of it that, regardless of how ingenious the idea was, it just seemed very difficult for the entrepreneur as well as the VC sorting through that environment. It seemed to be very muddied and difficult, and hard to differentiate companies and whether to make investments, and there were barriers. And as part of that, I started working with Archipelago. Actually, I was the lawyer for the three founders of Archipelago, and I'm not sure on which side of the pond anyone is, but Archipelago is very famous on the East Coast of the United States because it became the first company to really execute equity trades over the internet in the late 1990s.
Right.
And that phenomena we were hoping was going to simplify the investment cycle and make liquidity easier. And as I worked on that, other things began to be born, which was really the entire algorithmic electronic trading world was born as a result of Archipelago. And the story of Archipelago is fascinating, and I could talk about that one for hours. But my former client, Jerry Putnam, and business partner, went on to become the chairman of the New York Stock Exchange, because obviously financial technology swallowed up manual floor trading. By 2005, Archipelago was bigger than the New York Stock Exchange, and
right.
In that large capital marketplace environment, doctors use a euphemism called a side effect. I don't look at side effects. There's just effects. Some of them are unwanted.
Okay.
And there was an unwanted effect that I began to notice, which was I was working on venture capital and private equity transactions, and the liquidity markets for those transactions became increasingly more and more and more difficult as the algorithmic trading expanded. So the private equity markets and the private transactional markets were no longer looking for public money. And, that was always a good answer when we were raising money, which was, how will I recuperate my investment? And the answer was, well, we'll go public.
Yeah.
And when the company's public, the VC and the early stage investors will harvest the wealth. That no longer exists. And it hasn't existed for close to 20 years. So I started working on that problem about 14 years ago. And this is the financial lane I'm talking about. So converging in my career, this financial lane of discovering the barriers to the clients I wanted to help most, which were at the time actually VCs. I really wanted them to make good investments, because a good investment, I used to call it, doesn't come off the shelf. You want to, as a lawyer, you want to do the transaction, have them make the investment, and then the investment goes well.
Sure.
When the investment goes poorly, the legal file comes back off the shelf because people are upset and bad things happen. So what I really started to work on was methodology, technologies that would help to price, do valuation, streamline the transaction, make sure that everyone could know transparently what the company was all about, so my investors were making informed decisions. But the back end liquidity was always a problem. So I'll put a pin in right there. So secondary liquidity, reselling a private company was just a pressure point in my life.
Was that because companies weren't being successful around the first time round and they weren't structured correctly? What was leading to that problem existing?
It was actually the opposite. Because the bad companies, or euphemistically the dogs with fleas.
Sure.
There's nothing to be done about that. It's just either it's a bad idea, or the company is not a good company, or some other inherent miss about that particular investment was missed. Okay.
Right.
Sometimes it's missed, and it's, there's civil lawsuits. Most of the time that isn't the case. Most of the time it's not the idea whose time has come, and it only has a short life. Those are fewer and further in between. What the real problem is the company that did an 8% return. It was successful. And they needed to move to a new level. And they either needed more capital, they needed to be acquired by a big company, they needed some other particular form of help. And it usually involved a liquidity problem, because they're making sales, they're modestly profitable, and everybody's kind of bored with the company. And I began to realize those 30 and 40 years ago were actually companies who could have done a small public offering.
Interesting.
And so now you have this very broad audience of good companies. They're private, but there's no ability to resell the private investment. There's no marketplace anymore. The marketplace disappeared. And it really disappeared because the public marketplace, unless you're a unicorn multi-billion-dollar IPO, no one's excited about you.
Right.
So if you're a $50 million IPO, you're non-existent. That doesn't. Right. At one time, the marketplace had 400 to 500. The U.S. public markets had between 400 and 500, sometimes more than that, $50 million and under initial public offerings. I think we had 4 last year. So that marketplace collapsed, right? So, and the government, the Securities Exchange Commission, lots of professionals were extremely involved in what happened to the small IPO marketplace. In fact, the data, the research behind this, which I was part of helping to create, was published in the Wall Street Journal. The title of the Wall Street Journal article was "The Death of the Small IPO," because they died. It was like they were like dinosaurs. They were no longer existing. And then it became, okay, there's this effect. Remember, like I said, side effect. Well, what was the cause? You can look at effects all day long, but if you can't find a cause, you can't find a solution. So I really started in earnest to research causation. What was really causing the problem? And to take full responsibility as one of the people who founded Archipelago, high-speed electronic trading and the environment where the public markets only want the largest companies, because the shift in revenue models for investment banks and for public exchanges was based upon high volume and high frequency and the number of trade executions. It really was less of a concentration on how long it would take for the company to expand share value. So for just as an example, a $1 billion IPO will have more trading volume in its first few days of trading than a $50 million IPO may have for an entire year. Well, if your revenue model if your revenue model is based on trade volume, you're not going to try to sell into a marketplace that takes you a year to earn the same amount of money that it may take you a couple of days. And so there's causation. There's the capital structure, the marketplace's structure has changed. So with that, we then started to explore the solutions. And so that first lane, we were still on my career, I guess, that was the first lane. I had this epiphany that there was a necessary solution to come up with, born out of my years of experience as a CPA and a lawyer. And then the other side of my career, which is I took this viewpoint when I got my law license, which was, it's a good thing to earn a living, and I've never been financially, destitute or anything. So, but there was this element of what I was doing, a missing element, which was, I have this license that was designed originally to actually help the society at large. Being a lawyer wasn't merely just being in finance. And that's also a bit born out of my military experience, which was, I wanted leadership in our communities to recognize that if we don't pay careful attention to the economic problems surrounding us, they will eventually devour us. And I became very involved in my community. I became involved in the Black community in the city of Chicago. And I became a civil rights lawyer. I was recognizing that in the communities, sometimes I was trying to help Black entrepreneurs, and couldn't, but I realized that their environment, the area they lived in, the area they were trying to build their businesses in, was beset by a lot of problems. So I became a trusted person within the Black community in the United States. It wasn't just Chicago. I was working on community projects and, preventing, abuses of the government on, ethnic groups in Chicago, both, not just Black people, but Blacks, Hispanics, believe it or not, Italians. So I started this work in that community, and that was a 25-year lane. And they converged very recently, where I've just recognized that the data we have is that 92% of all jobs within a corporation are created after its IPO. So if you have a firm of 100 people and you can reach the public capital markets, you will expand your job creation tenfold. That's not data that I was part of the team. So there was something called the IPO Task Force about 10 years ago that studied the problem of IPOs. So think about that. If you have access to public capital markets, you can 10x your company. And you 10x it in terms of meaningful living wage job creation, not just hourly minimum wage jobs. So career path jobs, human resources, marketing, production, quality control, public relations, investor relations. These are career path jobs you can get in your lane and run for your entire career. And if you don't have public companies, well, naturally it puts pressure on the other forms of job creation. In the United States, we have this huge debate over whether minimum wages should be going up. And, welcome to McDonald's, may I take your order, could now, which was once a job when I was a child, was an afternoon job for a high school kid. Now it's a career. So, but I thought, where are the other jobs? And so I looked at that statistic that I helped to examine, and then I really began to look in the Black community. In the United States, the New York Stock Exchange has been in existence for 230 years. There has been one Black-owned company ever listed on the New York Stock Exchange. Not 1%, one company. So if you take those statistics, and it doesn't take a mathematician to logically look at, okay, we have a community of people in the United States that have not participated in the public markets, which means that job creation in that community is non-existent. So if you have more public companies growing, and so the convergence of that in my career was, okay, I'm able to look at this problem because I'm in that community. I'm also in this finance community. And as those two things converged, that's when I really, about 5 years ago, became very active in formulating the solution, because the main difficulty for the VC private equity world is, how do we know we're a success if we can't recapture the wealth of the investment because we're owning the private company? Now, average VC private equity investment is about 7 years. It used to be about 36 months. So if you have to be long in the investment when you make it, well, now you really have to concentrate on making sure that company's highly profitable, because it's the only way you're going to recapture the investment. Whereas in a public capital market, you now have the ability to, for any reason or no reason at all, decide to harvest some of the shares and recapture the investment to invest elsewhere. No public capital market, no jobs, no public capital market, no liquidity for the investors. So without a small public company capital marketplace, overall, the fabric, not just of, this is more of a problem in the United States, believe it or not, than it is like Great Britain has the alternative investment markets. They have their version of a venture exchange in London. They're smaller companies. They have about 1,000 listings. It is definitely an avenue to recapture investment, and has been done successfully many times. Believe it or not, right now, the newest venture exchange in the world is in Beijing. Excuse me.
Sure.
So Beijing went, we need to cultivate the best ideas, the most imaginative companies, the most imaginative staff, the people who are actually creating our societies a better mousetraps. We need to get capital into that marketplace. And literally 2 months ago, the Chinese created their first ever venture exchange, and it's flourishing. Their trading volume is huge. They're listing companies in China, and the United States is still lagging behind in creating this marketplace. It's a private marketplace, and this is not throwing any disparaging remarks on VCs or private equity firms. They're great. They're a necessary part of the ecosystem. It's just that they don't have a supply of avenues for which they can graduate in the ecosystem to the next level, which is a public market. So we've designed that solution. So there's where I guess my career path kind of all converged on what I'm doing now. That's what I'm doing now, is formulating that first ever solution in the US.
In terms of the growth, I'm kind of interested in a couple of things you said there as well. I want to get into minority ownership for sure. I think one of the things that I've noticed, albeit from my standpoint, is I've had the good fortune of joining a company before it went public. In HubSpot, for example, they were at Series D in 2013. They were at $100 million in funding. They were valued over $1 billion when they IPO'd a year and a half later. and they've gone on to be a success story. As I work placing rock stars in pre-IPO companies, in the main is what we do. The funding levels we're seeing are now quite insane. I mean, they've jumped considerably. We're now 8 years on from that, soon to be 9 years on from that. You're seeing early rounds 5, 10 to $15 million, and then you're seeing Series D and Series D $500 million. So these companies, I know one off the top of my head, I won't mention their name, but they're at 728 million in funding in a Series D, and they're on track to do an IPO in probably 2 years. But it's just the level at which they are funded right now is absolutely insane. Like it's just pre-IPO, the level of money being pumped into them is insane. Profitability is a secondary consideration. So I'm interested in what you noted about being profitable, but now you're talking around unicorns and numbers and market share. Because traditionally, as a small business owner myself, it's all about profitability, and that's the primary concern, to keep the lights on. Whereas it seems to be a funding ahead of your IPO is all around, market share, grabbing because this unicorn idea. And then it's a matter of going public and offsetting your liability to the public markets and gaining market share and turning the profit tap on. Maybe just share with us your thoughts around that, the growth that you've seen and what it takes to be successful in the VC world and IPO world now, and why. What did you mean by profitability versus, my take on market share? If you could expand a little.
Yeah, sure. I can totally expand on that. In fact, this is hitting the nail on the head. What you've just described as sub problems to the problem we're discussing. So the reason you're seeing such enormous private capital rounds in CD, EFG rounds is because there isn't usually that risk in a private equity or a VC environment was passed on to the public markets. Historically, that's what happened. They went public earlier, perhaps even at an earlier stage, and to some degree, the larger amounts of capital that were needed were done through the public market. So now there's you're identifying what has happened. We have now concentrated risk in a private capital market, so it's become a relationship-driven environment. So if you are, let's just say that you're worthy of a $200 million private round.
Sure.
Well, where does a small company go to create a $200 million round? Well, it's a relationship-driven marketplace. So what's underneath the relationship? What's underneath the relationship is this war that exists between profitability and valuation, where you'll see many companies, even public companies. Tesla is a great example.
Yeah.
Tesla wasn't profitable until last July. So how did they garner such an enormous valuation, and how was it possible for a public company, let alone a private company, to continue to thrive in an environment where they actually weren't really making any money?
Sure.
And this goes back to the research. This is 14 years of my research. And there are certain characteristics of that emerging company. They're in the white paper, by the way. Thank you for mentioning my white paper. But if you look at those characteristics, you can begin to estimate the effort of that company to actually make it, not just in the private capital markets, but graduating to a public market. And what's most important about that is the value of the ideas. And we've inverted the balance sheets of most huge corporations in the world. At one time, 2/3 to 70% of the value of a corporation was in property, plant, equipment,
of course,
facilities, right? So, General Motors, Ford Motor Company, the large auto manufacturers are a great example. At one time, they had plant and equipment on their balance sheet that were enormously valuable. Well, today that's inverted. More than 2/3 to 70, sometimes 90% of the value of a company it's in its intellectual property. So what do they really have? Well, they're very nimble. They outsource the building and manufacturing. They
Yep.
outsource the supplies. They no longer pull internally what is something that can be fairly low margin profitability. They outsource the low margin work,
Yep.
and they retain the intellectual property. No one really knows where your iPhone is made. But we know that Apple owns the intellectual property. It probably has, I think one estimation was there are something close to 5,000 patents that are required to make an iPhone.
Wow, great stuff.
Right. And no one knows where it's made. It's not like you walk up to the Apple computer plant somewhere in, New Jersey.
Sure.
The Apple computer construction is global. The supply of allowing someone to have a little eyedropper of the intellectual property to manufacture circuitry, to manufacture, to buy raw materials, to have the use of the intellectual property to actually make a thing is now the value of the organization. So we've become a society where the value of the idea, the imagination of the creator of the idea, is far and away skewed in whether or not the investment is going to work out or not. So if you've truly invented something, if you truly are a tech pioneer, or I've seen this across all areas. One of the spaces that I've worked in considerably was in medical products, not pharmaceuticals, but medical products, where people came up with new alloys for steel to be used in surgeries.
Yep.
That were significantly more valuable because of their ability to resist certain environments. Water and wastewater treatment services still is booming. The ultrafiltration systems, things that are, when you get down into the weeds and you are actually looking at what the manufacture of a thing is, and the labor and raw materials and plant and equipment that goes into it, versus the idea, we've become a much more nimble global supply environment where outsourcing of the making of it, because you have the idea, really does in fact supersede valuation in a small company. And you'll see it. It's the canary in the coal mine on this is the tech companies. So you'll see these enormous valuations. Instagram is a great example. Actually, WebEx is a great example. WebEx was never a profitable company when it was a private company. It never made money. And I think it sold for 32 times revenue. So I think their gross revenue was 100 million. I think they sold for 3.2 billion. They'd never made a profit. And so you have to be capable of generating the capital during that stage to keep the lights on. And there's the early infant angel investor stage, which you're addressing right now. I often joke, I talk at universities very often.
Okay.
And I joke, you're not really an entrepreneur if two things exist for you. One is if you have a full-time job. Okay. If you have a full-time job doing something else, well, that's your job, and you have this side gig being an entrepreneur. Well, you're not really an entrepreneur. And the second thing is, if you've never put your payroll on your credit cards at least once. So I run across the entrepreneurs and they're like, okay, there have been no sales this week. It's going to take 8 more months to get our private capital in. How do we make it? And they begin finding ways to put duct tape on things to make sure that they make the bills. And all of those considerations have really caused the marketplace to be in an environment where only the very, very, very rare and best idea, like the supreme idea, the cure for cancer, as opposed to the 100 companies that may have contributed to that, are realizing financial rewards and wealth harvesting, and it's just a much narrower community. So what we're trying to do is to broaden the capital base by which the willingness of a VC to get involved and see that the company's targets and milestones, this is of utmost importance. If the company is making milestones towards the finality of where profitability will come, that is one of the, I would call it the top 3 considerations. In other words, if they consistently miss the milestones, sometimes these companies miss milestones by years. Well, that has to be balanced against the potential future reward. Mm-hmm. So Tesla is a great example. They always miss their milestones. They really didn't get to market with the speed, with the public acceptance of the electronic vehicles that a patient VC would have handled. But in the public markets, people went, great. They have a workable electronic vehicle that can be sold at a retail price acceptable to the public.
Yep.
Where do I invest? Sign me up, because they're going to make it. They make their milestones. And so moving the early stage company from pilot project to commercialization to broad market share to profitable broad market share, and working them through those stages is something that the public capital markets are infinitely more patient with today. Private capital markets are also more patient with it, but the difference is there's no transfer of risk. If you're a PE or VC, you're either going to syndicate and you're going to convince by relationship that your friends and your colleagues should come together and support your VC investment for the long haul, because they can't get out. There's no exit unless the company has made it. The big company doesn't want to buy them. And if they make it, great, you can harvest the wealth, and there are plenty of exits to Big Co. But one investor of mine that I worked with for many years, he would take a pass on so many investments that had the potential to be 10 times return or 20 times return. I said, why do you always pass on the ones that are the potentially biggest ones? And he said to me, I like 12%. I like 12%, where passing off risk doesn't mean that I've got to count on winning the game with only a second to go and we've got to score. Okay. He goes, and great, we'll win and we'll all celebrate. I would much rather be on the team that does 12%.
Yep.
That keeps consistently making it and making it more and making more. And those are the small public companies. Those companies that are kind of doing the work of the community and are really working hard towards meeting their goal, if their goal is really a very worthy one. That in and of itself becomes a primary factor in either making the investment, what the type of company you want to join with. So, when you're looking at a company, and I think HubSpot is a wonderful example.
Why is that?
I think it was a bunch of MIT guys.
That's right.
And it was funny, because if you really search the origins of HubSpot, I think their director of sales had never held a sales position in his career.
Correct. Yeah, Mark Reverge.
Mark. So, and I think he may have authored a book. I think it's called The Sales Acceleration Formula.
That's correct.
It's a brilliant book. And when you look at HubSpot and how it was formulated, he's a true entrepreneur. He sat down and he said to himself, okay, what do I know? Well, I'm an engineer from MIT.
Right.
How can I create a formula, naturally, because he's an MIT engineer, to apply to an environment in which I have very little experience? I don't know how to sell anything. So if I can sell something successfully once, and I can repeat that formula, and I can make milestones, and then I can train other people to do exactly what I've done, now I can garner market share. And I think, he alone is probably responsible for the enormity of the success of HubSpot. And what was his idea? It wasn't just the idea of HubSpot. It was the idea that anyone can do it as long as I create the characteristics of a good salesperson. I can build out a sales team. And I think he grew sales in 12 months from like 3 million or 4 million to 100 million. And historically, what we would do is go, oh, we need a sales guy. We need an expert in sales.
Yeah.
And they didn't have that. So that's the trueness of what I'm saying, which is, do they make milestones? Are they producing on something? And the origin of it is, well, HubSpot was an idea whose time had come. So
Yes.
now if you take that and you apply, it's an overarching good goal, good idea, enhancement to our abilities to work with one another. There are soft factors, there's subjective factors looking at the company. Then you have to look at how are they going about that in a very pragmatic way. Those are characteristics that will lead that company to the largest public companies in the world. Microsoft is another example. We have research on all those companies and how they went from little tiny acorn into beautiful oak tree. So yeah, that what you're saying really hits the nail on the head. It really is about the management team.
Sure.
And do they produce and make milestones, and stop looking at their pedigree, because that's in the past. And what are they doing today? How well do they perform today? And how well are they performing on an idea that has the potential to have a long-term effect on its market? And those are kind of trite sayings right now. I'm being a bit glib because there's a tremendous amount more detail that we're using at our exchange to correctly identify candidates for our listings in the future. So yeah, that you're spot on. Revenue and profitability are secondary to the idea and its potential, and whether or not the people who own the idea are capable of actually putting that idea into motion and making the milestones to carry it through to fruition. And that's an unfortunate truth. It's a paradigm shift in investing that has already happened. I'm not inventing this. I'm just identifying it correctly. And what's really needed is the both passing of risk from the private markets to the public markets. But in addition to that, the ability to create wealth in the public markets for the entrepreneur, for his team. That publicly available stock is something that's very important. The Facebook guys are a perfect example. The early Facebook employees were stuck from 2008 to 2012. Facebook went public in 2012. The early Facebook employees who no longer saw themselves with vital roles. So it wasn't Mark Zuckerberg, but it was the team around him. They wanted secondary liquidity, and they could never say, well, when is Mark going to take the company public? It wasn't their choice. So they may have had $200 million worth of Facebook stock, which was you couldn't buy coffee at Starbucks with, right? Great, it's a privately held company. On paper, I'm worth 200 million. So in fact, what they did is they went to a small company called secondmarkets.com, and they created a secondary marketplace for selling pre-IPO Facebook stock. Well, Facebook should have been public already. It would have done no damage to their IPO pricing for the wealth transfer to commence 4 years earlier or 5 years earlier. So, but why did they have to go to secondmarkets.com and go through a labyrinth of exemptions to going public and secondary sales rules? Well, they had to do that because there isn't a small public company capital marketplace. Now, there's an argument to be made, and I'm not unaware of this, that if you own something and you own 100% of it, and it's incredibly valuable and it's throwing off enormous dividends and profitability, maybe you don't want to go public.
Sure. Yeah.
Okay. It's not for everybody, but there's a vast number. In the United States, we've actually counted that it approaches 100,000 small companies that would necessarily be eligible for the marketplace we're creating. We only need 3,500. Okay, if we have 3,500 companies in our marketplace, we'll be a wild success. There are 3,500 companies traded on the New York Stock Exchange and NASDAQ today. We had 11,000 at one point. So we have this shrinking public marketplace where only the very, very, very large companies are taking advantage of it. But if we open that public marketplace, it creates liquidity for the VC. It creates job opportunities for the entrepreneur and his team. It creates secondary liquidity, so you can create stock options and employment compensation plans that are actually meaningful instead of giving somebody private company stock that they can't sell. There's just so many benefits to a small public company marketplace that recognize the primary factor, which is an idea whose time has come is extraordinarily valuable, even if it doesn't have huge top line revenue and doesn't have huge earnings, profitability that it can show. So we're creating that marketplace. You have to have 3 years of consistent profitability today to even be eligible for the NASDAQ at its lowest listing tier. Well, if you don't have 3 years of profitability, how can we bypass that system? Because it isn't as important, because the value of the company is where the employees and the early investors are really concentrating their energy to determine to invest or not, or to determine to take the job or not. Is it going to be successful, and can I harvest wealth? Because I'm giving up salary.
Sure, of course, yeah.
You're giving up your life's milk. You're burning your hours working in that company. And look, if the company doesn't become profitable and doesn't become profitable is the wrong word. If it doesn't become valuable enough so that you can harvest the wealth that you as an entrepreneur, the sweat equity you put into it, well, you may as well get a job. You may as well go take a job that pays more money. So correct identifying of the idea whose time has come and the management team that can make its milestones are of senior importance to whether or not the company is just wildly profitable in today's environment.
Okay. Joe, what I'd like to do is I'd like to create a part 2 of this recording, if that's okay with you.
No worries.
We're coming up on time here, and
Okay.
I've been jotting down a multitude more ideas around questioning profiles. So what I'd like to do is we're going to wrap this up for part 1 and come back and talk to you more around smaller cap companies that want to go public and should go public because of the criteria you mentioned. I also want to get into minority ownership as well for part 2. I want to go into that, some exciting companies I've seen come to the fore as well. So if it's all right with you, let's schedule some time to grab a session for part 2. And
I would love to do that.
Thank you kindly for your participation for what is now part 1.
No worries. I know it's often been said, you put a nickel in, you're going to get the full. I've been at this 14 years, really 30 years. So part 2 is perfectly perfect. I'm more than willing. This is my life, and I love sharing it, and hopefully your audience is going to get a lot of
fantastic. Me too. Okay, well, look, let's wrap up for part 2 and wrap up for part 1 and welcome you back for part 2 as we move forward. Watch this space, folks.
You've been listening to the Global Tech Leaders Podcast, designed for both established and aspiring career-focused tech rock stars, as well as helping leadership figure out how to speak global in today's multicultural world. For further details, check out sf-talent.com.